The market is hoping for both a soft landing and rate cuts next year on this falling inflation. But how likely is that to actually happen? Sarah Eisen asked Treasury Secretary Janet Yellen, the former Fed chair, about that earlier on Squawk on the Street.
My baseline is that we'll achieve a soft landing. Are there risks? Of course, there are risks. We could experience another global shock that could be unsettling to that path, that could jolt inflation upwards or have adverse effects on the economy.
Well, one of my next guests still sees some bigger risks than that and is calling for a recession in 2024, maybe a mild one. Let's bring in Subadra Rajappa, head of U.S. rate strategy at Societe Generale. We also have Stephen Wieting, chief investment strategist at Citi Global Wealth Management Investments. Welcome to both of you. Subadra, you guys have the recession call?
We do. We have a recession penciled in for the middle of 2024. And I think that we think that it's going to be a mild recession, and the Fed is probably going to have to act aggressively starting as early as the May meeting. We have about 150 basis points of cuts penciled in for 2024 and more in 2025. So we do think that this ultimately might end up being a very normal, usual type of rate cut cycle. And, in this sort of context, I think that the Fed probably sounds a little bit more hawkish. There's no rush for the Fed to suggest that they're going to cut rates. So we're pushing back on the market pricing of cuts for the March meeting, but a May rate cut seems very possible.
Steve Wieting, I missed the CPI data yesterday, but I heard people saying it was a little bit on the hot end. Again, talk me through that. Is that report carrying more weight? Do you think it could be a really dovish PCE report that could be to come? And let me just point out, this is going to break our new graphics back there, but the 5-year break-even inflation rate, 2.08% right now, Steve Wieting. That means the market almost has them missing their target to the downside right now before we even price in any real economic slowdown.
Other than the recession call, we're all talking about really highly tactical, tiny little insignificant shifts in the history of the story that we're going to be tell. I mean, central banks generally cared about inflation targets and whether they hit them over the course of a decade. Let's look back at the period after the global financial crisis. Well, we were below target for that decade. Now they're talking about whether or not we should adjust monetary policy a little bit up or down based on a CPI report. I don't think that that's really what's going on. So we've managed now to take inflation from 9% at the headline level down to 3% at a headline level, and there have been no jobs lost. And the labor market has shown signs of easing on the margins. I've lost 3.3 million job openings. But by and large, again, this has shown that supply shocks, upheaval in supply and demand mismatches really generated the inflation in the last couple of years. Now, we can talk about the economy, but does the Federal Reserve need to punish the economy? Does it need to force up the unemployment rate to get the inflation rate down to something that will look like target in the next few years? And we don't think that's the case. We think that the case is very clear here that a slowing in the labor market will be enough for them to move off of restrictive monetary policy a bit towards neutral. I bear in mind in 10 of the last easing cycles, the Federal Reserve cut rates while employment growth was still positive, and the 6-month average was 146,000 jobs in that whole period. And we're including the Volcker Fed.
So, Steve, why don't you just follow up on that real quickly? What do you think Powell's going to try to say today?
Well, I think he's going to say the Fed is still uncertain whether they've tightened sufficiently to guarantee that they will meet their inflation target. And it's, of course, as Steve Liesman just said, again, reinforcing their recent message. And all of that is fine because they can never be absolutely certain that they're going to hit their inflation target.
Right.
But will he also, in questioning, again, entertain what does it take? Why would we be easing monetary policy without a collapse in the economy?
Right.
What will it take to protect the economy?